Hello, I'm Robert and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. In today's video, I'm going to talk about the different types of dollar cost averaging. Yes, there are actually three different types or methodologies of dollar cost averaging, and knowing when to use them is important for profitability. If you use the wrong type in the wrong market, you will take losses, usually in the form of simply running out of budget. So that is what we're going to get straight into with method 1. This is the most common approach that everybody is familiar with, and it goes by a wide variety of names: staking, drip or dividend reinvestment programs, reoccurring buys. All of that falls under the first method, where all you do, no matter what, is at fixed intervals you purchase. That's all you do. And the intent behind this is that as you purchase, your price averages to a certain point, but that helps you with purchasing and receiving dividends and staking, meaning you have an appreciative reason for not wanting to sell opportunistically. That really is the whole intent of method 1. For example, whether it's Iron Mountain, SPY, AT&T, it doesn't matter, or some cryptocurrency exchange that gives you staking on a particular asset. The goal here is you are rewarded for purchasing and holding that asset over time. Now, that whole premise has one significant key factor to it that makes it why it is so unique compared to other forms. It doesn't have an exit strategy. The goal of the process is never to exit. That is, you keep building on your average over time, and as you keep building more and more, you get bigger rewards from holding it, whether it's in the form of a dividend or in the form of a staking reward. Nonetheless, you are making money from putting more into it. It's much like the context of what you get out of your savings account, where your savings account lets you earn interest over time. It's the same basic principle with no work or anything other than you setting up your consistent purchases or reoccurring purchases on a regular schedule. Common schedules might be once a day, once a week, or once a month. Certain cryptocurrency exchanges allow for once an hour or such of that nature. But really the process is just the same: constant and consistent interval-based purchases. When you use this strategy, if you're trading an asset that does not have staking or dividends, this strategy will cause long-term losses because you have no exit in mind. It has a very limited place and should only be used in that limited scope. As we can see from the screen, it tells you how many days that it has been running since it started and how many purchases it has taken. And this is once an hour. Now, if you go to the daily chart, since TradingView shows 5,000 candles, then you're basically getting 5,000 days, if it will switch. So 5,000 days, okay, in this case it's tracking 2,090 days, and it's made 2,092 purchases. And you can see one of the biggest drawbacks to this kind of a method. It's wonderful when price is dropping, but when price goes up, it drives the average up as well. So you have to understand that your average will increase with every single purchase if the price is going upwards. Now, if the price is going downwards, then the average will go down as well. But there's no way to really opportunistically sell this and get a profit if your average is climbing as rapidly as your pricing. And that's why this is only good for staking and for dividends, because the intent here is you don't want to sell. You don't want to give up what you are holding. So when you want to sell and you want the opportunity of profits, then you need to use either the second or third method of dollar cost averaging. Method 2 of dollar cost averaging actually does have an exit approach, and it has a very clear rule for when you exit. This is the most common technique used in cryptocurrencies. It's not the only technique, but it's the most common. In this case, the blue line represents the average. So you make a purchase. The blue line is the average of your purchase. The green line is your take profit. In this example, our take profit is 2% of our average. The red line is the deviation or next purchase point that is a factor of the average. In this case, whatever the average is, the next purchase point is going to be 1.5% below the average. This is an extremely aggressive dollar cost averaging method, but it only purchases when the price is lower. So your average will never go up, which means if the price does go up above the green line, this process will exit with a profit. And as we can see here, we can see how it becomes aggressive. Price is 1.5% below the average, and every candle below that average is a purchase until it drives the average down. And it continues to drive the average down appropriately. But it only purchases when the price is 1.5% below the average. Now this can be any value you want. It could be 2%, it could be 5%, it can be 10%. That is strictly up to you. But method 2 strictly requires that the price must be a certain point away from the average. It will not add to your average unless that is true, which is a very good way of profiting, because at some point you're going to literally go above your average, and everything you've accumulated you're going to sell at a profit, and that profit can be quite significant. The advantage to this is it reacts very aggressively to the market, but the disadvantage is that you need to plan your budget out carefully, because you have no control over how much you're going to accumulate. That can be a real big problem that can burn your budget up very quickly in the wrong market. Now this is just purchasing on every candle. The proper way to use this is with a strategy combination, such as Bollinger Bands, RSI, MACD, ATR, some combination of indicators that specifically looks for a targeted entry point that gives you the best opportunities to get in and out of the market without such aggressive accumulation. But I wanted to demonstrate the principle clearly so you can see just how aggressive this technique really is. So when you use it, you must think about your strategy, because your strategy is what limits how much accumulation you take on or how many steps you take on. For example, if we look at the statistics, the statistics are that it has made 382 complete trade cycles. Now, a trade cycle in this context is the very first purchase and every purchase afterwards up to the complete sale of the entire asset. So from here all the way to here is one trade cycle. And we can see that the average trade cycle is 21 positions. That's not the maximum, that's the average. But this gives you an idea of just how aggressive this technique can be. And it is incredibly profitable if you have the budget to sustain some of the incredibly deep and brutal accumulation cycles that you're going to encounter. For example, as we see back here, when things really get vicious, where is it? Like March of 2020, for example, when the market just went ballistic. Right here. This is a good example of just how aggressive it can purchase. You're easily looking at 50 or 60 positions before it made a sale. Method 2's most critical drawback is that you have no real control over how much it purchases outside your entry points, meaning the technique you use to actually decide when you purchase. So you have to have a great level of care in how you get into the market to decide when you want to purchase to add to your position. It is by far one of the most profitable forms of dollar cost averaging, though. It really does do a generous job. And as you can see here, when you're in an uptrend, it just goes to town making profits. And when you're in a downtrend, it accumulates all that into a position looking for the golden opportunity. It is a wonderful technique when used properly. Now for the final method or technique, the dollar cost averaging method that uses the last purchase price. This often gets called defensive. You'll hear it as a ladder approach or a step approach. Sometimes you'll even hear staircase. It is really a very powerful tool and the best way, particularly if you are a new trader in trading. If you're completely new to this, it's the best way to get into it because it has one very critical advantage. You can actually measure the entire volume of any asset in a very specific number of steps, and it doesn't matter. For example, if you want to limit your budget to $1,000 at $10 a position, you can measure out the percentage of whatever your asset is by 100. And then that becomes the stepping ratio of your trading. For example, let's demonstrate that by going back to this trade. Let's find the beginning of it. And talk about the whole process. Okay, so here we go. We have the process. We see it made 3 purchases at 1.5% deviation. Then it stopped and it became stuck in what's called a channel. Anytime the price just hovers between the deviation and the take profit, it is often referred to as channel locked, meaning it's not going to purchase and it's not going to sell. You just have to wait for either the price to go above the green line or below the red line where it will purchase. And you can clearly see that it limits price extremely well. For example, we have 4 positions, but we don't make any purchases when the market is running in this channel, or even if it goes above the average. It's completely opposite of the aggressive state. It deliberately uses the last purchase price to decide its next purchase price. In this case, whatever the last purchase price is, the next purchase price must be at least 1.5% below the last purchase price. Again, you can use any percentage you want, but by measuring out exact steps, as you can see, it looks like a ladder or staircase. So by measuring out those steps, you guarantee and limit the amount of trades you take on. That is, you actually have a worst case scenario, so that no matter what, this market will never exceed a very specific budget. You can limit everything you do strictly based upon that knowledge. But it has one severe drawback. If price just stays between the deviation and the take profit, you make neither a purchase nor a sell, and you end up just holding the asset for what may be a very long time. The problem with this technique is the more you accumulate, the more difficult it becomes to get out of it. Because as you see, even though we are accumulating, it's becoming more sparse in between the zones. And at some point, you're going to end up with this situation, a long-term channel. And you can see just how long this channel can last. The one thing that this method does is it gets rid of time. You are pretty much within reason guaranteed a profit at a very limited exposure rate for a maximum budget. But you are not guaranteed how long it will take you to actually reach that approach or that profit. As you can see, 4 months, 5 months holding before it took another deviation or more deviations. And you can see it can become quite extreme. So you can end up in a very long-term cycle holding an asset, waiting for it just to move. As we can see by looking at this, it's just sitting here. Now, if you're using a account that has fees for margin or holding, this could rack up fees in the process. You need to think about that when you do your stop loss or take profit orders. Excuse me, when you do your take profit only, because you won't have a stop loss. So your take profit needs to think about fees, if you have any, that you're going to accumulate for the holding process, because you're not guaranteed how long this is actually going to take. You could be sitting here for a month, multiple months, or even years waiting for price to go in your direction. It all depends upon the market. But you will be guaranteed that no matter what, you will never exceed your maximum budget for this asset, just because you're using only steps, and you literally measure out the entire volume of this asset in those steps. So in the case of Bitcoin, that had a high of 67,000 and then it dropped aggressively, it would take a long time, if it bought at the top, for you to reach an average with this approach. But you are guaranteed that whatever number of steps you allow, you will not exceed a fixed budget. So it's great for beginners, but it's slow. So let's go through and recap the different styles. Let's talk about the very first one. Method 1. Always purchase at fixed intervals. Stocks with dividends or cryptocurrencies with staking. That is the only time you should use this technique. Never, ever in Forex. There is no value in Forex or any stock or any cryptocurrency that doesn't offer a dividend or a staking reward. If you aren't getting something for holding it, this is not the best technique, and it can, over time, rot your portfolio away. Method 2 is the aggressive technique. Deviation is always a specific percentage away from the average. This is the common technique that a lot of bots in the cryptocurrency market use. It's not the best technique unless you have a good, solid strategy in place for when you purchase. That is the most critical part of the second technique or second method. You must have a good, sound strategy. The third technique, the one that I believe is the best one in many respects, is the ladder or step, often referred to as defensive. It keeps you from accumulating large quantities, but it takes time out of the picture. You are at the mercy of the market, and a severe bear market can cause you to wait a very long time. You need to think about your fees. You need to think about any commissions you pay for holding, so forth. Now, techniques like hedging or inverse correlation, they can help in the middle as you trade different assets with limited potentials, but they're all part of your risk mitigation approach. This is the most defensive approach of dollar cost averaging. It is the best if you're learning, because you can guarantee through a very specific amount of trading that your asset is never going to go below a certain point. For example, let's take Bitcoin at $30,000. You can take that, divide it by 100, for example, and guarantee that no matter what the price does, it will not exceed 100 steps. For the purposes of this setup, using a 1.5% deviation, the entire volume from the first purchase all the way down to zero will not exceed 67 steps. So 67 steps is my whole budget. So if I use $10 per step, my budget, no matter what, will never go above $670. That is critical when you're dealing with dollar cost averaging. The fact that you can specifically and precisely guarantee your budget is a significant reason why this technique is so popular. If you're dealing with $10,000 and you know an asset is not going to go above $670, then you know how many assets you can trade simultaneously and not worry about blowing up your account. By using this technique with aggregation or multiple assets, you gain the benefit of a wide range of market conditions through different assets, always bringing in small profits over time. It is a significant and critical point that makes it worth understanding. So let's actually focus on the final numbers. We see here 111 trade cycles. And we see the average is about 3.29 positions. So that is the most defensive technique. Now let's look at the aggressive technique. And you see that the average number of buys per cycle is 21, with the average number of trade cycles being 382. This is by far the most profitable, but the highest risk. This can blow your account up if you don't plan for a huge budget, or if your positions are too large and you just don't take into account how bad the market can go. Your entry point is everything here. A bad entry point is going to be a bad day, because the computer is going to make it completely 10 times worse than you can ever imagine. Always test. Always back test. Always forward test. Always look at the circumstances of what you are trading in a worst case situation. Methods 2 and 3 are the best ways to trade opportunistically with the intent of making profit. Method 3 is the best way to trade defensively and guarantee you have a very fixed budget. That is critical when you're dealing with futures markets or margin markets, where you're going to pay a fee for what you're holding, and liquidation becomes a real critical possibility. As you explore which technique is best for you, always think about how the market is going to be unpredictable. It is often better to take small profits over time with the absolute guarantee and insurance that you're not going to blow your budget up than it is to risk a liquidation. Hopefully this information will help you make the right choices for your trading to maximize your profitability. Every single one of these techniques has its proper place, and it can be incredibly profitable when done right. Every single one of them can be disastrous, though, when done wrong. So test, test, test. Do your research, analyze the market, and if you have any questions, please leave them in the comments and we'll be glad to answer them. I answer every question on these videos. Like this video and subscribe if you're not. If you like this video, it helps me get this kind of content out to more people that may not understand that there are differences in dollar cost averaging, and together we can make a difference in making the most out of the markets and helping people learn the right way to trade. Subscribing means you get more content as I release it. Plus, I always take into account what subscribers ask for content to produce next. Thank you for watching, and I really appreciate it. Until next time.